Welcome to vTalkInsight, Risk Sentiment Daily for February 25th, 2026. Credit cracks are starting to look uncomfortably late cycle just as the AI investment boom accelerates, leaving headline indices calm, but the risk backdrop far from settled. Risk sentiment today is cautiously balanced, with headline indices pointing to calm while positioning and flows reveal growing unease underneath. The S&P 500 is less than a couple of percent below record highs and posted a gain of around 0.75%, while the VIX has slipped back below 20, suggesting surface-level confidence. Yet commentary highlights elevated dispersion and derating beneath the index, as investors reassess winners and losers rather than buying the entire equity complex indiscriminately. In rates, 10-year Treasury yields are hovering just above 4% and near year-to-date lows, helped by ongoing disinflation, steady growth data, and a bid for safety amid trade and geopolitical tensions. Flows show renewed interest in aggregate and core plus bond funds, with many clients still underallocated to bonds and now seeking broader fixed income exposure. At the same time, crypto assets are under pressure, with Bitcoin logging its steepest monthly drawdown since 2022 and stablecoin supply shrinking, even as some large investors quietly accumulate via the $60,000 range and new exchange-traded funds. Safe haven demand extends beyond treasuries, with central banks and BRICS countries adding to gold reserves and the US dollar posting its strongest week of the year against the euro, underscoring a persistent risk-off bid alongside ongoing equity strength. Market participants also argue that tail risks remain structurally underpriced and that portfolios are underhedged for true crisis scenarios, which helps explain why even minor data surprises or policy headlines can trigger outsized swings. Against that backdrop, three bearish forces dominate the conversation today: rising credit stress and late-cycle behavior, AI equity concentration and valuation risk, and escalating tariff and geopolitical supply threats, all offset by selective support from the AI infrastructure capex boom, rotation into resilient, asset-heavy equities, and renewed demand for quality fixed income. Rising credit stress and late-cycle risks are increasingly central to how investors are framing today's environment. Early signs of strain are emerging in structured credit, particularly in collateralized loan obligation equity tranches, where price action and behavior are starting to resemble the 2005 to 2007 period ahead of the global financial crisis. At the same time, there is growing interdependence between banks and non-bank lenders, as traditional banks now back a substantial share of non-bank loan commitments, increasing the channels through which stress could propagate across the system. Within private credit, exposure to the software sector is highlighted as a particular vulnerability, with classification ambiguities potentially understating how concentrated some portfolios really are. Major private credit players warn that a higher cost of capital is likely to trigger meaningful defaults and market disruption, especially for leveraged software names that thrived on cheap funding. Senior bank executives are also flagging signs of risky lending behavior reminiscent of the pre-2008 era, as competition pushes some institutions toward looser terms and illiquid deals to boost near-term profits. There are, however, important nuances that temper the most extreme scenarios. Many private credit funds, particularly listed business development companies, are structured with permanent capital or tight redemption limits, which helps mitigate classic asset-liability mismatches even when redemptions spike. Most funds also report quarterly holdings with detailed loan information, challenging the narrative that the entire sector is opaque. Moreover, several observers note that as long as economic growth holds and recession risks remain distant, credit markets can stay broadly constructive even while pockets, such as structured credit or riskier software loans, reprice. The key takeaway is that credit is moving from a benign tailwind to a potential transmission channel for shocks, so movements in high-yield spreads, CLO equity, and private credit fund behavior are likely to be critical indicators for risk sentiment from here. AI equity concentration and valuation risk is another major overhang. The recent stock market rally has been narrowly driven by a handful of AI-related names and infrastructure beneficiaries, while broader cyclicals such as financials continue to lag, leaving leadership unusually thin. Markets are increasingly volatile as the AI trade matures, with most investors already heavily positioned in perceived winners and incremental buying power limited, which raises the risk that any disappointment could trigger sharp corrections. NVIDIA's upcoming earnings are a focal point here. Consensus is looking for roughly 68% revenue growth and gross margins around 75%, numbers that set a very high bar and make the risk of disappointment meaningful even amid strong demand signals. Although successful volume production and shipment of the company's latest GPUs could help clear that bar, there are lingering concerns about execution on the next generation after prior delays affected share price performance. More broadly, markets are questioning whether current earnings power for high-return, asset-light tech businesses really justifies their elevated multiples, with observers warning that any shift in sentiment could drive a multiple-led correction rather than an earnings collapse. This skepticism is already visible in record inflows to software exchange-traded funds that look like aggressive dip buying, even as the software index tests a long-term support level and volatility remains high in AI-exposed sectors such as software and financial services. Concerns are compounded by reports of major tech firms using off-balance sheet accounting tactics typical of late-cycle environments, and by fears that AI-driven job displacement could eventually weigh on demand. At the same time, there is a powerful counter-narrative grounded in strong fundamentals for AI infrastructure, with robust capex plans, rising productivity data, and only modest net job losses so far in AI-exposed sectors. The net result is an equity market where AI winners still attract capital, but where crowded positioning and stretched valuations leave indices sensitive to stock-specific surprises. Escalating tariff and geopolitical supply risks are adding another layer of uncertainty that feeds directly into inflation, growth, and corporate behavior. The current U.S. administration's aggressive use of tariffs marks a sharp break from decades of post-war policy focused on lowering trade barriers, with the White House considering raising global tariff rates from 10 to 15%. Studies, including work from the Federal Reserve Bank of New York, indicate that roughly 90% of U.S. tariffs are ultimately paid by domestic businesses and consumers, raising costs across supply chains and complicating an inflation backdrop where price growth has slowed but overall levels remain uncomfortably high. Recent Supreme Court rulings have pushed back on unchecked executive authority, clarifying that Congress holds the core tariff power and that certain emergency measures are time-limited, which should reduce some long-term policy volatility. Section 122 tariffs, for example, are capped at 150 days without congressional approval, but companies must still pay them immediately, creating near-term cash flow and compliance burdens. Even where tariffs are later ruled invalid, the refund process can take up to 2 years, and businesses face administrative complexity and legal costs along the way, all of which is encouraging management teams to delay capital expenditure and hiring. Beyond tariffs, geopolitical tensions are reinforcing supply-side risks. National security concerns are driving new trade restrictions in sectors such as pharmaceuticals, steel, aluminum, and rare earths, while China's export controls and sanctions on key Japanese companies add to supply chain disruptions and negative sentiment for Japanese assets. In the Middle East, the largest U.S. military deployment in the region since 2003 and fears over Iran's nuclear ambitions raise the risk of an oil supply shock from the Gulf, which could trigger commodity-driven inflation and even stagflation that monetary policy is ill-equipped to handle. These dynamics help explain continued demand for safe haven treasuries, defense equities, gold, and the U.S. dollar, even as spot oil prices are tempered by expectations of future supply growth. On the bullish side, AI infrastructure capex and an emerging earnings boom are providing a powerful counterweight to the macro and credit concerns. AMD's expanded partnership with Meta, involving 6 gigawatts of AI compute deployment, is a case in point, with each gigawatt expected to generate double-digit billions of dollars in revenue and Meta committing to multi-billion-dollar purchases over 5 years along with sizable equity warrants. AMD estimates that the AI accelerator market could reach $1 trillion over the next 5 years, and similar themes are playing out across semiconductors, advanced materials, and foundational AI labs as capital shifts from traditional consumption toward data center and infrastructure buildouts. Elsewhere, companies such as SanDisk and other hardware names are seeing outsized share price gains on the back of storage bottlenecks and AI-related demand, while select firms like Xi Technologies report around 20% growth tied directly to AI projects. Macro data suggests that rising productivity, partly driven by AI adoption, is supporting growth with only modest net job losses so far in AI-exposed sectors, reinforcing a base case of AI-led productivity gains and sustained GDP expansion. That said, the same investment surge raises short-term risks of overheating in inputs such as power and construction, and the crowded nature of the AI trade means that even fundamentally strong stories can be volatile as the market discriminates more sharply between future winners and losers. Another supportive theme is the rotation into resilient, asset-heavy equities as investors seek cash flow durability and lower technological obsolescence risk. There is a visible move away from software and other new economy names toward hard assets such as energy, real estate, and commodities, helped by low starting valuations and improved operational efficiency in these sectors. Within equities, capital is gravitating to utilities, telecoms, financials, staples, and healthcare, areas seen as less exposed to AI disruption where companies with high capacity, strong networks, and relatively low obsolescence risk are being rewarded with record highs. Year to date, consumer staples have significantly outperformed discretionary stocks, underscoring investor caution around more cyclical spending, even as data such as Home Depot's earnings beat shows pockets of resilience in smaller ticket home projects. Flows are also rotating away from U.S. equities toward Europe and Asia, particularly into sectors perceived as more insulated from AI disruption, while European defense companies benefit from structurally higher military spending and the political appeal of domestic defense investment. However, this rotation is not without trade-offs, as many of these sectors generate lower returns on invested capital. European valuations have already re-rated, and factors such as a stronger euro or renewed geopolitical shocks can quickly alter earnings trajectories. Renewed demand for quality fixed income is the third important bullish element in today's risk narrative. Investor flows are shifting toward aggregate and core plus bond funds, with clients acknowledging that they remain underexposed to bonds and now seeking diversified exposure across treasuries and credit rather than narrowly targeting a single sector. 10-year Treasury yield sitting just above 4%, near year-to-date lows, reflect a combination of ongoing disinflation from a 9.1% peak to around 2.5%, steady if unspectacular growth, and a strong desire for duration as a hedge against equity and geopolitical shocks. Despite some widening in high-yield spreads and the credit cracks discussed earlier, commentary stresses that in the absence of an imminent recession, the overall outlook for credit remains broadly constructive, particularly for higher-quality issuers. Structural features in many private credit vehicles, such as permanent capital and limited redemptions, help contain run risk, while regular portfolio disclosure pushes back on the idea that the entire space is opaque. Balancing that, Federal Reserve officials have turned more cautious on inflation, keeping policy firmly data-dependent and pushing out the timing of rate cuts even as markets and clients continue to expect multiple cuts over the coming year, which could cap price upside if inflation proves stickier than hoped. Putting this all together, risk sentiment is finely balanced. Credit and policy risks are building, AI leadership is narrow and volatile, and tariffs plus geopolitics threaten supply chains. Yet AI infrastructure capex, rotation into resilient cash flow assets, and renewed demand for quality bonds continue to support the overall cross-asset picture. Watching how structured credit behaves, how AI-heavy equities trade around key earnings, and how tariff and geopolitical headlines evolve will be crucial for understanding whether this balance tips toward a more decisive risk-off phase or stabilizes into a durable, if choppy, soft landing backdrop. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, Visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.